Hey there, this will be a quick video because it's basically going to be the mirror image of what we did the last time. So previously we talked about buying and selling of put options. What is a put? This time we're doing what is a call, and we're going to buy, or we're actually going to sell a call. Sorry for the glare behind me. It's early in the morning here, and even closing the blinds, it actually makes it worse. So let's go to the slideshow. There's only one slide today, so if we go to the presentation, so this is just basically the mirror image of what we did last time. So a call option, this is what is an option. Here's our put option terminology, call option. A call gives the purchaser of the call, or the purchaser of the option, the right to buy or buy a given stock on or before a certain date at a specific strike price. So why would you want to buy a call? Well, it's a speculative play, usually. There's a large potential for making money. You can make a lot of money on a single call if there's a big movement to the upside in the underlying stock that the call covers. There's limited risk, just like puts. You can only lose what you paid for the call. But the issue is there's a low probability of success. There's a low probability of profit, and unless you get very lucky, you're probably going to lose money. So the seller, just like in the put, the seller potentially incurs the obligation, in this case, to sell the stock at that strike price. Just like selling puts, the selling of a call, a naked call by itself, carries a lot of risk. If the stock blows up to the upside, there's some event news. Say you're trading a company like Tesla, and they blow out earnings, and you have you're short a call. You could potentially be in store for big losses, but there's generally a high probability of profit. So rather than just rehash kind of what we did last time, let's switch over to the trading platform and look for something to sell. Okay, so here we are in Tasty Trade. My idea was, because oil has been on a tear the last couple of days, is to put on a trade in exchange traded fund ETF. It's a fund that tracks oil called USO. So I go up here. I want to enter USO and look for a trade in September. Okay, so here's our option chain. The stock is trading a little bit above $80, and the terminology is going to flip. So when we talked about puts being in or out of the money, a put was in the money if the stock price was below the strike price. So if I were selling the 74 put, this would be out of the money because the stock is above the price. If the price were, say, 72, the 74 put would be $2 in the money. So that's reversed for the calls. So if I come up here and I sell, I don't know, let's sell the 90 call. So this is out of the money because the stock is below the strike price. If the stock rallies up to, say, 92, this call would be $2 in the money. So as things stand now, this looks like it's going to have roughly a 19% probability of expiring out of the money. So 19% chance of making at least keeping all of this. The probability of profit here is about 83% of making at least a penny. The probability of making 50% of the max profit is, it looks like, about 86%. So I'm going to, let's see if I can get a couple more cents for this. I'm going to route it at 130. I am not filled, so I'm going to go back to the activity tab. I'm going to adjust. I don't know why OBS does not record these little pop-up context menus here. Oh, there it goes. I am filled. So, yeah, so this is good. I don't need to do anything. So that's all there is to it. So that's it, guys. Both of these, the calls and the puts, are pretty simple. I don't generally recommend these for first trades. Selling a put is fine. Selling a call is a bit dicier for most people. So in the next couple of videos, what I'm going to talk about are what's known as option spreads. They sound complicated and fancy, but they're pretty straightforward. They're just using multiple options to create a different type of position. So we're going to look at vertical put and vertical call spreads. which are probably a little more beginner friendly. The probability of profit's not as high, but the amount of money you can lose is a little bit less. So that's what we will do next time. And until then, see ya.